Yes, sir. Good afternoon, viewers. I, Iffat Unnisa Begum, Assistant Professor of Commerce from Government City College and a moderator for today's live teleconference. I, on behalf of Dr. B.R. Ambedkar University, and I, on behalf of me, I extend a warm welcome to all the viewers and to our resource person who join us today in live teleconference. Today, we have an insightful session on a topic income from capital gain for BCom final year 5th semester students as well as for PG second year students. During this session, we will explore about a capital gain, capital asset, difference between capital asset and a non-capital asset, how to calculate long-term capital gain, how to calculate short-term capital gain, how to apply cost inflation index while calculating index cost of acquisition, index cost of improvement and exemptions under section 54. Joining us today, we have esteemed highly resourced persons with us today. Our first resource person is Professor B. Usha Kiran ma'am, Senior Most Professor from Osmania University, and our second resource person is Dr. S. Jhansi Rani ma'am, Associate Professor, Head Department of Management from Government City College. I welcome you ma'am. I welcome you ma'am both for this live teleconference. For the first 45 minutes, we will be having an in-depth discussion with our resource persons, whereas the last 15 minutes we will be having a question and answer session where if you want to participate, please call us on a number which is scroll on your screen. I read the number, that is 040-2368-0456. I repeat the number 040-2368-0456. But make sure whatever the questions you are asking, whatever the doubts you are asking, it must be related to today's topic. So let us begin the session. Before asking the question, I just want to give you a brief information about today's topic, that is capital gain. Whenever we sell a property, maybe a gold, maybe a land, maybe a building or a share or any valuable asset, we often make a profit. But that profit doesn't always belongs to our salary, that doesn't always belongs to our business profit. That belongs to a special category, that is capital gain. Capital gain is a profit earned from selling an asset for a higher price as compared to its original purchase price. So let us begin the session by asking a question to our first resource person, that is our Professor Usha Kiran ma'am. Ma'am, I want to ask you to give a brief information to our viewers about a capital gain according to income tax point of view.
Yeah. Actually, capital gains are nothing but the gains or the profits that are earned by selling or transferring capital asset. Basically, it is one source of income or one head of the income which is to be shown in the aggregation of the total incomes. When we consider the capital gains, the sections of the act, if we are looking into, the capital gains are dealt from section 45 to section 54, wherein we have got all different concepts which you will be and we will be exploring as such. And capital gains, as I said, whenever we have certain kind of assets, especially land, buildings or shares, debentures or jewelry or gold, or they may be patents or artworks or maybe bonds, securities, all these are the capital assets. Whenever a capital asset is transferred, so we will have to understand the meaning of transfer also. Whenever capital asset is transferred for a higher price than the acquisition price, then we get the profits. Those profits are taxed under the head capital gains. So that's the meaning of capital gains.
Thank you so much ma'am for giving a brief information about a capital gain. Next question, let's move forward. I want to ask with Dr. S. Jhansi Rani ma'am. Ma'am, can you explain the difference between a capital asset and a non-capital asset?
Yeah. So when we talk about the income from capital gains, first let us understand what is the meaning of capital asset. Why? Because we get a gain when you sell the capital assets. So again, under this we have two types of assets, that is short term capital assets and long term capital assets. So let us first differentiate what is the meaning of capital asset. As per the section 2 subsection 14, here capital asset means any person or any assessee who holds any property or any investments in the foreign institutional investors as per the SEBI guidelines, or any investments done in the properties, we call it as capital asset. But as it was asked that the differentiation between capital asset and non-capital asset. So here I just want to put few points that there are some assets which are excluded from the meaning of capital asset. For example, if you take stock in trade, here when we talk about the stock in trade, if you take the example of a motor car dealer, for him motor car is a stock, and gold or ornaments for the jewelry dealer, it is a goods or stock in trade. So in this case, it does not come under capital asset. And similarly, for example, if a person purchases any car for his personal purpose, or anything or any goods used by the personal purpose, that is also will not come under, and it is excluded from the example like furniture or any other things, excluded from the term called capital asset. But if you take the example of a person purchased car and he is used for his personal purpose, later he is selling it, then it is not considered as a capital asset. But here also there are certain things or certain items which are termed as capital asset, though they are used for the personal purpose. Example, if you take jewelry or any archaeological items or any paintings, drawings, architect or any other items like this which are having precious value, we call it as, in that case these will become a capital asset, though these are used for the personal purpose. And here ornaments, especially when we talk about the jewelry, here we have various things of ornaments which are made up of gold, silver, platinum, and these are used specifically for the personal purpose, and these are movable, but still they are considered as capital asset. Here precious means again we have semi-precious stones, gems which are used in the for making of this jewelry. Similarly, if you take the example of gold coins, silver coins which are used for the praying the gods, for deities, these are movable and there is no personal interest, but still to show off their status or prestige, these are being used. In this case, these are also considered as the capital asset. So here under these are the items which are excluded from the capital asset. The first one is stock in trade, personal properties or personal use like car if you are using, and the next one is any land, agricultural land. If you are selling any agricultural land, it is not considered as a capital asset, but there are certain conditions that has to be taken into count when you are taking this agricultural land as a capital asset or not. So first of all, here we have different limits that are been given by the Income Tax Act. If within the municipality, actually when you call it agricultural land, we have two things. One is rural agricultural land, the other one is urban agricultural land. When we call rural agricultural land, where the population is less than 10,000, if you sell that land, it is not considered as capital asset. But there is a condition that if you are selling any agricultural land which is there within 2 kilometers and the population is more than 10,000 but less than 1 lakh, in that case it comes under the capital asset. Similarly, if it is in the within the radius of 6 kilometers and the population is varying from the 1 lakh, more than 1 lakh but less than 10 lakhs, more than 1 lakh, then it is considered as again capital asset. Again, if the agriculture land is within 8 kilometers and the population is more than 10 lakhs, then again it is also considered as capital asset. So only selling agricultural land does not mean it is capital asset or does not mean it is not a capital asset. By following these regulations and these conditions, if it is fulfilled, then only it will be considered as either capital asset or non-capital asset. And also apart from this, we have some bonds. If you invest in those things and if you are selling those bonds, then it is not considered as capital asset. Like we have gold bearer bonds which are issued in 1977, and that is 6% bonds, and we have 7% bonds which are issued in 1980. If these bonds are sold, then these are not considered as capital asset. So this is how as per the Act we have given a clear clarification that what are the capital assets and what are the non-capital assets. That's the meaning of differentiation between both the capital and non-capital assets.
so much, ma'am, for giving such a wonderful explanation. I hope all our viewers are having an idea about what will be the capital asset and what will comes under a non-capital asset. Now coming back to Usha ma'am, I want to know what is the difference between a short-term capital gain and a long-term capital gain?
Yeah, whenever property or capital asset is transferred, then we will have to see whether it is a short-term capital gain or a long-term capital gain. It all depends on how long that particular capital asset is held by the concerned person. For example, for the sake of calculation of short-term capital gain or long-term capital gain, or for determination of whether it is a short-term capital gain or a long-term capital gain, we will have to see the period of holding that particular asset. So, we have got financial assets and non-financial assets, and you know, all of you are aware that financial assets are nothing but the equity shares, or maybe the preference shares, or maybe debt funds, so on so forth. All these are listed or unlisted, everything comes into that, and all these which are dealing with financial nature, which are of financial nature, then you will have to call them as a financial asset, capital asset. Then all the others, like it may be jewelry, or it may be land, property, building, or agriculture land, or anything like that, then we call them as non-financial assets. So, here we will have to remember that how long that particular capital asset was held, right from the date of acquisition to the date of transfer. We will have to calculate the period. So, the date of acquisition is excluded, and the date of transfer is included in that particular calculation. Accordingly, when we are looking at the listed equity shares or equity mutual funds, if the asset is held for less than 12 months, that is, let us say you are purchasing the asset in November and you are selling it in the next February. So, it is not 12 months period. So, in that case, whatever are the profits you are getting, then they are called as the short term capital gains, because the asset is not held for more than 12 months, but it is transferred below the 12 months period. So, automatically if the asset is held for more than 12 months, then it becomes a long term capital gain. Let us take another example, that is immobile property or land or buildings, so on so forth. In such cases, the period is taken as 24 months. So, if the asset is held below 24 months, then whatever is the gain we are getting on transfer of such property, then we call that as a short term capital gain. On the other hand, if we are selling it after 24 months, that is about 24 months you are selling or transferring, then in that case whatever gain you are getting, that is called as a long term capital gain. Then we have got zero coupon bonds, again it is a kind of a financial asset. Therefore, obviously it is nothing but a financial asset which is held only for 12 months period. Below 12 months it is short term capital gain, and above 12 months it is long term capital gain. And in case of other assets like jewelry, paintings, etc., we have got this duration as 36 months, which is something like if we are holding it below 36 months and transferring it, then you call it as a short term capital gain. On the other hand, if it is held more than 36 months, it is going to be called as a long term capital gain. So, the student should remember that what is the period of holding, and remember what is the kind of asset. So, these two things you have to remember very carefully. One is the period of holding, and the second thing is what kind of asset it is. And based on the asset, based on the holding, we will have to determine whether it is a short term capital gain or a long term capital gain. Just to repeat, I am telling you that all the financial assets, if they are held below 12 months and transferred, then automatically whatever gain we are getting considered as a short term capital gain. On the other hand, if we are holding it more than 12 months and transferring it, then whatever gain we are getting, that is considered as a long term capital gain. In all other properties, all other cases, it is generally 24 months period, and below the 24 months, if you are transferring the capital asset, whatever profits we are earning, they are called as a short term capital gains. And on the other hand, if we are holding them for more than 24 months, then we are transferring, then it is called as a long term capital gain. So remember, the students have to take care of these two things. One is the holding period and the nature of the asset.
Thank you so much, ma'am, for explaining with such a live examples. Now moving forward, I want to ask with the second resource person, that is Dr. Jhansi Rani ma'am, what is induction, that is cost inflation index, and how and why it is applied while calculating the capital gain?
Yeah, it's right, because when we are calculating income from capital gain, especially with regard to the long term capital gain, we go for the indexation. Here indexation means the change in the price that is happening due to inflation in the prices and the price increase in the prices. And this indexation or the index values are given by the government, that Ministry of Finance. Every year it changes, and indexation will bring the actual value rather than paying more tax to make it an equal to the value of the asset purchased. For example, an asset may be purchased or any land is purchased in the period of 1990 or 2001 and it is sold in 2004 and 5. Maybe the value of that asset may be in the 2001 it is 10 lakhs and now the asset value is 1 crore or 2 crores. It is an injustice to pay the tax on this whatever crores earned in this present current year, that is 24 and 25. So to make it assessee profitable and to make assessee not to face a loss or not to pay more tax to the government, to make it benefit to the assessee, this indexation has been introduced. So this index values will bring the actual value equal to the value of asset that has been purchased in the year of purchase itself. So this index values will change every year, and as per our previous year, that is 24-25, and our present assessment year 25-26, the index value what we use is, the value is 363, and this indexation is applicable only to the long term capital assets. Why? Because short term capital assets are hold, if you take the example of shares, it is hold only for the period of 12 months. But whereas land and other buildings, it will be called as short term if they are selling before 36 months. So in that case, if any asset is sold more above 3 years, that is 36 months, then the index values will be taken into consideration. So this is how the index values will work out, and this is applicable only to the long term capital assets, not to the short term capital assets. And this index value will help especially to the assessee to pay the tax as per the present value of that particular asset whatever he is holding. It may be land, it may be building, or if it is in shares, if he is holding more than 24 months, then also it will become the long term asset apart from the listed or unlisted. If you take aside, then it will become the long term capital asset. Then they go for the indexation. So indexation is very important in case of the long term capital assets. This is how we will try to understand.
Thank you, ma'am, for explaining with such a good explanation and with the help of steps. Now I want to ask with our first resource person, that is Professor Usha ma'am. Ma'am, what are the steps involved in calculating the capital gain?
Yeah, the students have to understand certain words, basic terminology. The first thing is a full value consideration. So here whenever a capital asset is transferred, then whatever price we are getting on the transfer, which is known as a sale price, that is known as the full value of consideration. Let us say I am selling my house property for 20 lakhs. Then this 20 lakhs becomes full value of consideration. So the first thing what the student has to remember is take down the full value of consideration from the given problem, and then from there you will have to deduct the cost of acquisition and cost of improvement. And before we do that, if there are any expenses that are occurred, that have been incurred because of the transfer, certain legal formalities may be there, or some stamp papers maybe have to be purchased, or maybe you have to pay to the broker. So all these commissions or the legal expenses, or sometimes the travelling expenses also, travelling expenses in the sense after the transfer, even certain travelling has to take place. So even those things can also be considered. So in case of jewellery, the commission paid to jewellery seller, or maybe in case of shares, the amount of brokerage or the commission what you pay to the person. So all these things are to be considered. So from the full value of consideration, you will have to deduct the expenses. So the whatever is remaining, that we call as a net value of the consideration. So let me continue the example that I got 20 lakhs by selling the property. So my full value of consideration is 20 lakhs, and I have paid around 5 lakhs towards the brokerage. Therefore, now what would be my net sale consideration?
20 lakhs minus 5 lakhs, that is 15 lakhs. Now
this 15 lakhs is the net value of consideration, from which we will have to deduct the cost of acquisition and cost of improvement. If it is a long term capital gain, if you are selling the property within about 24 months, then it is a long term capital gain. If it is within 24 months, then it becomes a short term capital gain. So in case of short term capital gain, generally we do not apply any indexation. However, in case of the computation of capital gains for the long term capital gain, we will have to apply the indexation, and which is nothing but the cost of acquisition and cost of improvement are adjusted to the inflation values as such, because I might have purchased this property long back, let us say maybe in 2010. So now it is 2026. At that time I might have paid only 4 lakhs rupees for acquiring that property. Then afterwards I might have incurred some expenses towards the improvement. So all those improvements, renovations, or any such things, maybe extensions, all these things we will have to take into consideration, and then take the indexation value for that, and then you will have to deduct these things from the net value consideration. Whatever is resulting, that is known as the long term capital gain. And without indexation, in case of the short term capital gain, simply full value consideration less the expenses less cost of acquisition, then you will get the short term capital gain. So this is how the capital gains have to be computed.
Thank you so much, Ram, for explaining in such a detailed way. I hope all our viewers will have an idea how to calculate with the help of steps. Now moving forward, I want to ask with Jhansi ma'am, how is a capital gain is calculated in case of sale of shares and bonus shares?
Okay. So when we take how the capital gain is calculated in case of shares and bonus shares, if they are a period of less, actually they comes under short term if they are holding less than the 12 months. So here first I'll take the calculation part for the short term capital gain, which is for less than 12 months. If you look at here, we have a problem that is Sri Ramana of Hyderabad purchased 500 shares of a listed company on 1st June 2024 at rupees 200 per share and sold them on 15th October 2024 at rupees 280 per share. If you observe here, he purchased on 1st June and selling on 15th October, which is very less than the 12 months. So that's the reason we call it as short term capital gain after selling if we get the profit. And the brokerage paid is rupees 1000. As it was explained just now, how do we calculate the short term capital gain? That is full value consideration, means at the value at which the particular asset has been sold, that is called as full value of consideration. And if you look at here, the value which is sold is at rupees 280 per share, and that too 500 shares he is holding. So the full value of consideration is nothing but at the price at which the capital asset is sold. So here 500 shares into 280 comes to 1,40,000. And then comes, if we have any transfer expenses that are like brokerage, commission, which are included when we are having the transfer of those shares. So that would be deducted. And if you look at your expense on transfers, or we call it as brokerage, which is incurring to 1000, and less cost of acquisition. The shares were purchased on 1st June 2024 for 200 rupees of 500 shares. So this is called cost of acquisition, nothing but the value at which shares were purchased actually. So that would be deducted. 500 into 200, it comes to 1 lakh. And whatever the benefit we get, that is 39,000 is our short term capital gain. This is how we do the calculation for the shares or the bonus shares if it is a short term capital gain. I hope you all have understood this, and if you just look at here, this is how we do calculation part with respect to the short term capital gain, that is full value consideration minus transfer expenses. Then we go for the cost of acquisition, or whatever, if you are getting more positive figure, then we call it as capital gain. If you are getting a negative figure, we call it as a short term capital loss. This is how we do the calculation of short term capital gains.
Thank you so much, ma'am. As students always, they'll check about the assets, but they are not having an idea how to apply when they are having about the shares or a bonus shares. But with the help of your explanation, I hope all our viewers are having a clear idea how they are supposed to calculate. Now moving forward, I want to ask with our first resource person, Professor Usha ma'am. Ma'am, what are the major exemptions which are available to us under capital gain scheme?
Yeah, whenever the capital gains are accruing to an individual, an assessee, then under tax planning, he or she can avail certain exemptions. And as far as the exemptions are concerned, we have got various exemptions which are dealt in section 54. We have got so many like A, B, C, D, E, F, so on and so forth. And let us just in a one shot, let me explain to you what are all the exemptions that we have under capital gains. The first one is whenever you are talking about the exemptions, the question is how the exemptions are helpful to the assessee. That let me explain you little bit on that, and then let us move to the exemptions part. So as far as exemptions are concerned, as I told you, if your long term capital gains are very high, you have more capital gains, either you may be having the short term capital gains. So when you are paying income tax, all those incomes, especially whatever you are gaining, either by way of long term capital gain or the short term capital gain, you are going to add them as and show them as one of the income sources and aggregate, and then based on that the tax will be determined as such. And to avoid paying more tax, which is considered as a tax planning always, we should think in terms of planning our taxes in such a way that tax liability is reduced. And that is why always in the beginning itself we will have to see how much we are going to get on salary, how much we are going to get on house property, all these things we have to take them, note down, and then accordingly put them together and see how exactly we can reduce our tax liability. This is within the limits of law. Therefore, tax planning is very much essential and need to be taken into consideration. So, for that purpose, all those taxpayers who have got their capital gains either by way of the long term capital gain or short term capital gain, they will have to look at the exemptions. So, that is one of the important aspects one has to remember. So, accordingly we have got section 54, which says that if any residential house property is transferred, then this residential house property, if you are reinvesting in another residential house property within 2 years after and before 1 year, then you will get exemption. The exemption is the actual long term capital gain or the cost of the new property which is purchased, whichever is lower. Accordingly, the exemption will be given. Example, if you are selling a residential house property and you are getting something around 15 lakhs as the capital gain, which is a long term capital gain, and let us say you are purchasing a new house for 10 lakhs. So, the difference 5 lakhs is taxable. On the other hand, if you are investing all the 15 lakhs and purchasing a new house, then in that case all the entire profits what you got by the sale of the residential house property are exempt. Therefore, it is for the individual, for the taxpayer to understand how well the exemptions can be utilized. So, that is how the taxes can be reduced. And of course, it can be, the house can be purchased either 1 year before or within the 2 years of the sale of the house. And the next one is 54B. According to that, any agriculture land, if sold, can be reinvested in land again for within the 2 years time period. That is one more thing you have to remember. And also for industrial undertaking, which is wherein there is a compulsorily acquisition has taken place, and 54D, and accordingly whatever gain you are getting, that can be reinvested within the 3 years period as such. And similarly, any other long term asset which is dealt in section 54EC, then any long term asset, if you are selling and if you are investing the gains in the bonds, especially the NHAI bonds or REC bonds, then you will be getting, but however you will have to invest, the amount should be below 50 lakhs and you should invest it within 6 months period, and also the lock-in period is 5 years. So, till 5 years you can't move your funds. That is one thing you have to remember. And then 54EE, which is nothing but any long term, 54F, any asset, not house already we have seen, but any other asset if you are selling, and the long term capital gain what you are getting on it may be again reinvested in the residential house property. So, here residential house property being sold and reinvested, that is under section 54, and 54F says any other asset if you are selling and you are getting the long term capital gain, in such a case this long term capital gain can be reinvested in the residential house property. So that you will have to remember, but remember the whole of net consideration must be invested, and the person who is reinvesting should not have any house, should not have owned any house as on the date of reinvestment. And then we have got 54G, where industrial undertaking is shifted from urban area to rural area. In such cases, in such transfer, if there is any long term capital gain which is being generated, maybe you will have to invest them in plant and machinery, or you can invest them in building, land, and this must be something like a shifting to the rural area, and reinvestment should take place within the 3 years period of time. And then we have got 54GA, which is nothing but industrial undertaking again, wherein there is a shift that takes place to SEZ. So whenever there is a transfer of industrial undertaking to SEZ, then again the gains what we are getting can be reinvested in plant and machinery and in building or land, of course within the 3 years time period. Then we have got another section 54GB, if there is any residential property sold. So remember, this is the third part on residential house property. One already residential property sold, that can be reinvested in residential property, that is one. And the second thing is any other asset sold, that can be reinvested in residential property. And now this is any residential house property is sold, and that amount, if any capital gains are realized, then they can be invested in eligible startup, or they can be invested in equity before the due date of ITR. So what is this ITR? Whenever you are supposed to submit your income tax return, before filing of income tax return itself, you should have invested the amount into the equity of any startup. So this is a condition that is being laid down. Therefore, these are the exemptions which one need to remember, one need to apply, and see that the tax liability is reduced.
Thank you, ma'am, for explaining in such a detailed manner. Usually our students are having somewhat doubt, like whenever they are applying the exemption, they are not having a clear idea which exemption, how much limit, whether they can apply the exemption or not. But I hope with your explanation all our viewers are having a clear idea when and how they are supposed to apply and how much time limit we are having for the exemptions. Next question I want to ask with Jhansi ma'am. Ma'am, can you explain the exemption with one of the example of long term capital gain?
Yeah, sure ma'am. I would like to explain how we do calculate the long term capital gains. As we know, if you see an example over here, Srimati Saraswati of Warangal. He has to shift the camera. Srimati Saraswati of Warangal purchased a vacant plot in April 2015 for rupees 5 lakhs, and it is sold in April 2024 for rupees 15 lakhs. So it was purchased in 2015 for 5 lakhs and it is sold in 2024 for 15 lakhs. And registration and legal charges are rupees 20,000. CII, that is cost inflation index, for 2015-16 is 254 and CII for 24-25 is 363. So here the asset has been purchased in April 2015 for 5 lakhs and sold in April 24 for 15 lakhs. And registration and legal charges are 20,000 and period of holding, it is 9 years. If you see from 2015 to 2024, it is 9 years and it is more than the 24 months. So it comes under the long term loan. And here the full value of consideration. So we are selling it for the 15 lakhs, which is called long term, and this is called full sale of value of consideration, means the price at which we are selling the plot, that is called long term capital value or long term capital asset which is sold. That value is called full value of consideration or sale value of consideration. Here comes the term called indexation, that what we have discussed. As in to make it, bring it to the equal value which was purchased in 2015, the value was 5 lakhs, now it is 15 lakhs. So what we are doing here? Here we are transferring it to, if you just look at here, if you just look at here, indexed cost of acquisition, the formula we have, that is purchase or cost of acquisition, we call it as. If for calculating the indexed cost of acquisition, we have cost of acquisition, that is purchase price we take, that was purchased for 5 lakhs into cost CII, that is cost inflation index of the year in which it is sold. So when the asset was sold in the 24-25 financial year, 2024 to 25. So 2024-25, the CII is 363 divided by the year of CII of the year in which it was purchased. So what we do whenever to do the calculation part of indexation, that too for the cost of acquisition, the formula is the cost of acquisition or purchase value of the asset into CII of the year in which the asset is sold divided by CII for the year in which the asset is purchased. So if you look at here, the asset we purchased is 5 lakhs into 363 divided by 254. It comes to 7 lakhs 14,567. This is called indexed cost of acquisition. And here we have transfer expenses, these are called registration and legal charges, that is 20,000. If you deduct it, you will get 7,65,433. This is called capital gain. As exemptions were discussed, here the plot, it is not a residential house, it is a plot. So residential house, and if you are selling any residential house property, again if you are in reinvesting in the same residential house property, we would have got the exemption of under section 54. But here there is no information about the reinvestment, but we assume it was reinvested in the same plot or same residential house property. So we will get the exemption of the long term capital gain whatever it has been received. So this is how we calculate the calculation part of long term capital gain. I hope you all have understood long term capital gain, and if you even look at here, as per section 44, we have different index values. You can see, look at the formula here, it has been displayed, that is indexed cost is equal to original cost. Original cost is nothing but the purchase or cost of asset at which it was purchased into CII of year of transfer, the year in which the asset is sold, that year index value divided by CII of year of acquisition, the whichever year the asset is purchased, that CII value will be taken, and this CII values will change. You can just look at here, and whenever you are doing indexation, and there comes the another point called indexed cost of improvement. For example, if you are having a residential house property or an house, and you have actually it was purchased in 1990 or some around that period, and 1990 if you have purchased and you have added 2 more rooms to that building, or you have added 1 more floor to that existing residential house, that is called improvement. Means earlier there was only 1 floor, later on in the 1995 you have added the another floor which is called improvement. So for that also you might have incurred some expenses, that is called cost of improvement, or the cost which you incurred for the construction of that an extra floor or extra rooms to the existing house, we call it as cost of improvement. Not only this, you can have an safety wall to your house or any gate or something extra you have added to the existing construction or existing building, that is called improvement. So this cost of improvement is also shown as a deduction while calculating the long term capital gain. Why? Because this all will make the assessee to reduce his capital gain and pay the exact tax that has to be paid to the income tax department. And when we are talking about the cost of improvement, it has done in my example, the house was purchased in 1990, improvement was done in 1995. So when I am doing the long term capital gain calculation, here we talk about indexed cost of acquisition as well indexed cost of improvement. As we have learnt indexed cost of acquisition, similarly cost of acquisition into CII of the year in which we are selling divided by CII of the year in which it was purchased. Similarly, for cost of improvement also we have a formula for that. That is improvement expenditure or the cost of improvement into the year in which sale has done divided by the CII of the year in which the improvement has taken. So in our example, the improvement has done in 1995. So in 1995, whatever the cost we incurred for the improvement, maybe it will be 2 lakhs or 1 lakh. For suppose if we take it as a 1 lakh, so 1 lakh into what is the year of selling? Our year is 2024-25. So whenever it is a 24-25, our CII is, you can look at here, it is 363. So our sale of year is 363 and divided by when we have done this improvement, we have done in 1995. So there was amendment made in the Income Tax Act that if you are doing any improvement before 2001, if you are doing any improvement before 2001, that will be not taken for calculation part. So how then? That's it. That is a rule. It has been amended. If you are doing any improvement after 2001, then only that improvement will be taken for the indexation. Suppose if you are doing the indexation in the year of 2015 and 16, if you look at here our CII is 254. So in that case, we will calculate like this. How we have discussed just now, that is 1 lakh is our improvement. So 1 lakh into 363 is our current previous year or the sale of year where we are selling our asset divided by the year in which we done the improvement. So we have done improvement in the year 2015 and 16. So in 15 and 16 our CII is 254. This is how we do the calculation part of indexed cost of improvement. So whenever we do the calculation for the long term capital gains, we deduct from sale of consideration less expenses or transfer expenses we would call. It may include brokerage or commission, other expenses related to that particular transfer. That the remaining we call it as net sale consideration. From that we deduct cost of acquisition, that to indexed cost of acquisition in the case of long term capital gains and indexed cost of improvement. Then we get the long term capital gain on which we will be paying the tax liability. This is how we have understood long term capital gains, the calculation part. And if even you can look at here, we have the another example, that is Sri Lakshman of Nalgonda purchased a plot of 2010-11 for rupees 8 lakhs and improvements worth 2 lakhs in 2013-14, sold in October 24-25. So this is how what I was explaining the example with indexed cost of acquisition as well as indexed cost of improvement. If you look at here, he purchased the plot in 2010 and 11. He improved that plot in 2013 and 14 and sold in 2024 and 25, that is 30 lakhs. And CII is 2010 for means the year in which he purchased is 167 and the year in which he did improvement is 220 and the year that is previous year 24-25 or the sale year is 363. So this is how I was talking, how do we do indexed cost of acquisition and indexed cost of improvement. I hope you all have understood how to calculate the indexation with the help when it comes to the long term capital gains.
Thank you, ma'am, for such a detailed explanation with the help of few illustrations. Usually whenever the students are solving, they are somewhat confused which CII they need to apply. Usually what they will do is the same CII they apply with the help of improvement as well as with the help of acquisition also. But I hope with the help of your explanation they are having a clear idea which CII where they have to apply. If any students, if you have any doubt, if you have any queries, if you want to ask with our resource persons, you can call us. The number is scrolling on your screen, that is 040-2368-0456. You can call us and you can clear your doubts. Moving forward, I want to ask with the Usha ma'am, recently few amendments have been made in capital gain. So please give us a brief information about this.
Yeah, the capital gains were almost, it was a game changer, we can say that, budget 2024. Because in 2024 so many changes have occurred in capital gains, the calculations part, and
The date on which it was accepted,
it was 24th July 2024, 23rd July 2024, and before that we used to have higher like for ST the short term capital gains and for the long term capital gains a different type of calculations, and there was also a rationalization of the holding period. Earlier for all assets it was 36 months holding period, but now there is a reduction in holding period to consider the capital gains. For many assets from 36 months period, the holding period is reduced to 24 months. That is one of the important amendments which we can think of. And then as far as the tax rates are concerned, we can see that earlier we used to have something around 10% on short term capital gains, and then we used to have like 111A, section 111A, which says that it is to be taken at calculated at 10%, and then exemption limit for the equity shares, it is considered as 1 lakh. Now it's been changed in such a way that it is something like the LTCG is taxed at 12.5% and STGC are now hiked to 20%. So the exemption limit is also changed from 1 lakh to 1.25 lakhs. So we have got something like a rationalization that has taken place, that is very, very important, and all the students remember the cutoff date, that is whether the asset was transferred, capital asset was transferred before 23rd July 2024 or after 23rd July 2024. It is because the post July almost for most of the cases it is 12.5%. So this 12.5%, if you are looking at, it is without indexation, and with indexation if you are looking at, it is 20%. So the option is available to the assessee where the property or the asset is sold before 23rd July 2024, he or she can opt for without indexation and with indexation. And if the property or capital asset is sold after 23rd July 2024, then in that case no such option, and a flat rate of 12.5% will be considered as a tax rate. And then remember all these exemptions which we were looking at, all these were, of course, then also we have seen that they have to be reinvested within 1 year and after 2 years, so on so forth, and unutilized amounts etc. Will be definitely to be shown in the ITR. That is a must, because whenever the property is transferred, the same year you will have to pay the tax as such. So that is one thing we will have to remember, and they are time bound now. All these exemptions are time bound, and the SSEs must definitely stick to the timings as such. And then another thing is about the section 50C and 50CA as such. They speak about the stamp duty value. This stamp duty value is sometimes, it is more than the actual sale price. In such a case, one has to see that the stamp duty is higher than the sale price. So one must be very alert about it. And similarly, unlisted shares, the FMV rule applies, that is fair market value rule applies, and all these things are going to already brought in many changes in the capital gains taxation. It is now, I can tell you that it has become little bit simpler compared to earlier period. However, there is a slight increase in rate of tax, that is something different, but for the calculation purpose it is something like fine, it is become simple as such.
Thank you, ma'am, for such a detailed explanation about the recent changes, because usually students, what they'll do, they won't check the recent changes. They'll go with whatever has been taught in the books and all, but they won't check the recent changes. But with the help of your explanation, definitely they are going to have an idea about this. I request Usha ma'am to please give your concluding remark on today's topic.
Yeah, one thing is certain that the student has to look into the assessment year for which the problem is to be solved. One has to keep that in mind, because the tax rates and the indexation etc. undergoes a change. And similarly, one has to be very careful with the holding period of the asset and determine correctly whether it is a short term capital gain or a long term capital gain, because the rates are something different. And in case of indexation, if it is applicable, look for the both, that is with indexation what is the tax rate taxes, and without indexation what are the taxes, compare and then accordingly choose the one where the property or the asset is transferred before 24th July 2024. So that must be remembered, and always remember the assessment year for which we are calculating the capital gains.
Thank you so much, ma'am. I request Jhansi ma'am to give your concluding remarks.
Yeah. So I would say the students that you should know what is the difference between capital asset and non-capital asset, long-term capital gain and short-term capital gain. How do we differentiate both long-term and short-term, and what are the assets that will come under short-term? When do we call them as short-term capital assets or short-term capital gain? And when you are calculating short-term capital gain and long-term capital gain, how do you calculate? What is the differentiation we look after? And when you will look at the new amendments that have been taken in 2024 budget, as it was said that if any asset which is purchased, long-term asset especially before 23rd July 2024, they have a option that either they go for the indexation or they can go for the without indexation. If they are going without indexation, it will be 12.5% of tax flat rate, and if they are going for indexation, it would be 20% of tax rate they have to pay on the long term capital gains. And when you talk about the short term capital gains, it was earlier 15%, but after 23rd July 2024 it became 20%, on which they need to pay the tax if you are having any gain on the short term capital assets. This is how you understand, and especially you should know the exemptions when you are either earning long term capital asset or short term capital gain. Exemptions will play a crucial role in getting the tax deduction. So this is how you need to know about the tax rules in respect to the long term and short term capital gains.
Thank you, ma'am. So dear students, I am sure that you have a wonderful insight about this subject, that is income from capital gain. I thank our resource person for sharing their wealth of knowledge with us. I thank I extend my thanks to the Department of Commerce at BRAOU for organizing such a lovely talk, and I thank the production and editing team at BRAOU Studio for making this live session possible. Thank you one and all. Keep learning, keep exploring. Thank you.